In this video sequence, I'll be discussing how I combine algos into a trading system. We'll be talking about the general problem, namely that there's no crystal ball. Then I'll go into the state-based design methodology. And then finally, I'll discuss and show an example of how I combine individual trading algorithms to create a system. Okay, feel free to pause this video. I'm going to try to go through this slide real quick. So remember, trading features is not for everyone. There's substantial risk of loss involved. My company, nor I, am a CTA. We're a third-party developer, which means there's no advice given. All signals are given to everyone, and they don't distinguish between different people. This is a letter of direction business, so you have full control over your account. And with that, I'll go ahead and get started. Now, before I jump into the actual design methodology, I want to show you what the problem is that I'm solving. Because generally speaking, I found that when I go straight into the state-based design methodology discussion, usually people are a little confused because they don't quite understand why I'm doing the things that I'm doing. So instead of starting with that, I thought I'd start with the problem. To do that, I just want to show you this S&P chart. This is a day chart of the S&P. And so in the period, not that it really matters, but this is basically 2018 plus part of 2019. And the question I have for you is, if you're a trader and you're looking at this chart, what is the correct trade to place towards the end of January, as this candle kind of points to? And again, this is assuming that you don't know what's going on, because I'm doing this video early 2020, so obviously we know what happened in 2019. But just think in terms of what would the correct trade be here to make. Do you go in the direction of the intermediate term trend and short at the resistance right up here, or maybe where it's at? Or do you just, for whatever reason, assume that the trend has changed and go long? Maybe you draw a trend line of support from this point here and decide to go long. Well, think about it. What would you do? And then I'll go to the next slide. So the correct trade would have been to go long. But of course, we really don't know that with certainty. I'm sure you could have made a good argument to go short and a pretty good one to go long as well. So then what about here though? So let's say, maybe you got it right though and you did go long. The next question would be, of course, well, where do you put your stop? When do you get out? And so suppose that we kind of went forward in time, and now I believe this is in around February now of 2019. What would you do here? I assume most of you would say go short, because it's pretty clear there's some resistance right here. And you could even envision putting a stop somewhere above that. But what would you do? Do you go short, or maybe you just assume that the S&P will break out of this trend and go long? Well, in this case, the correct trade would have been to go long, although there certainly was some kind of a pullback here before that would have occurred. But going long in the context of holding for a few weeks to a month and a half maybe, going long would have been the right trade. But then what do you do here? Do you short at resistance from September, October? Or do you assume the S&P will break out and go long again? And hopefully you see where I'm going with this. It can be very difficult to predict what the market's going to do. I mean, obviously there's no crystal ball in trading, and so all we're dealing with is probabilities. We know that there's arguments to be made that going short would be the right thing to do here. There's probably arguments that going long. I mean, look, technically, you did have a close above the previous close over here. So I know some technicians would look at that and say that that's a buy signal. And maybe they would have bought only to have been stopped out or go through a down period here. And then maybe they would say that that was a failed breakout. So definitely going short is the right move. But what would you do in this situation? Would you go short or do you go long? Well, if we go forward in time, you see that going short would have been the right decision. But again, someone could have made a case to go long and also one to go short. I think what I'm getting at is I don't know that there is a correct answer except for in hindsight. How about here? Do you go long when it hits support right in here from February, March, expecting it to bounce back? Or do you assume the S&P will collapse further and go short? Maybe you would have drawn a trend line from this point over around 2800 and gone long somewhere in here, only to have been stopped out or be at a loss. It's very difficult when you do this kind of chart analysis. And I don't mean to knock it, because I'm a technical trader. I do believe that there are edges to be had in the market by doing this kind of analysis. But what I intend to do with this is really just point out the big problem in the market, the problem that I attempt to solve in using this state-based design methodology. And that leads me to the final slide of this first section, which is kind of describing the problem, is that it's impossible to predict the market direction with 100% certainty. And I believe that there's a better way, that using something that I call the state-based market design methodology is a much more effective way, and it's a way to trade the market using technical indicators without driving yourself crazy. So what I do is First, I attempt to point out what I do know about the market. So I do believe that there are edges to be had. I do believe that there are certain technical indicators that can be helpful. But what I know for sure is that the market will either go up, down, or sideways for any given period, as long as I define those. But the market's going to go some direction. And the other thing that I know, and this is probably the more important part, different types of algorithms perform better than others depending on the market state. So what do I mean by that? I'll get to that in the next slide, but just generally speaking, what I mean is if the market is trending sideways, then a mean reversion algorithm probably will tend to do better. If the market has momentum and is going higher or lower, then a momentum kind of algorithm will tend to do better, and a breakout algorithm will as well, and a swing trade probably will do better. If it's going sideways, again, a day trade might do better than a longer term swing trade, because the day trade could get in and out more quickly, expecting the market to kind of trade sideways. But a lot of this I do realize depends on someone's trading style. So much of what I'm talking about, if it doesn't ring true to you, then that's okay. This really is particular to me and to my trading methodology, and to my trading style, and to my personality, and to what I know about my emotions. So again, what I do know is that I can't predict the market with 100% certainty. I do believe I can predict the market with certain degrees of certainty, but not 100%. I also know it's going to go up, down, or sideways, and that there's different types of algorithms that'll do better depending on the market state. Okay, so now what we're going to do is look at market states. I've kind of mentioned the term market states, and so I want to explain what I mean by that. You see, the market, as I said, it's either going to go up, down, or sideways. It doesn't take a rocket scientist to affirm that. In other words, it's going to go in some direction, we know. It's predicting which one that can be difficult. And if you could, by the way, then that would in essence be the holy grail. There'd be no need to have an algo. If we knew the market was going higher, we would simply buy and then get out when we knew it was going to go lower. And if we knew it was going to go sideways, we would just trade the range and sell when it hit resistance and buy when it hit support. And then, of course, if we knew it was going to go lower, we would just short the market. But the problem is we don't know. So that's where this market state can kind of help us, okay? So first, though, you have to define the states that the market might be in, and you have to do it in a way that makes sense. So in this case, a strong up state might be seen in these patterns that I have in the white arrow here, where the market is going higher with a lot of strength. And there's going to be certain characteristics of the market when that happens. Volatility will probably be contracting as opposed to expanding. Notice the volatility would have been higher back here, and up here it started contracting quite a bit. Now, just like you have these up states, you also have these down states, cycles where the market is trading lower. And notice how volatility is probably going to be increasing in these examples, although as it hits the bottom, it might not be. My point is just to show you that there's certain characteristics the market has depending on the state that we're looking at. So let me introduce a new concept to you now. It's this hero algo and villain algo, and it's something that I use periodically when I talk about the algorithms. So I just want to define what I mean by that. A hero algorithm would be a type of algorithm that does well in that market state. So if we're talking about a strong up state or a strong down state that the market might be in, a hero algorithm would be some kind of momentum algo, either long or short. In the strong up, it would be a long momentum algorithm, and in a strong down, a momentum short algo. The villain algo, meaning the algo that would struggle more, would be a mean reversion algorithm. Now, the reason why is because it would basically just blow right through the ranges that you thought it would hold at, and so mean reversion would tend to not do as well. Let's now look at this third state that I tend to use, which would be a sideways state. This one is a little bit harder to define because, up or down you can measure by was the S&P positive or negative. It's very rare that the S&P closes with zero, exactly flat. So you have to have some kind of a range, and I'll define that in the next slides that we do. But a sideways state conceptually is when the market is trading sideways. A breakout algo would tend to not hold as the market would revert back to some more stable price points. So in this case, the hero algorithm would be a mean reversion, one where you are trading the range, where as soon as it gets close to this range, you would buy and then get out as it approaches the top of the range. The villain algo in this case, the one that doesn't do as well, would be a momentum algo, one where you're going in the direction of the trend only to be kind of whipped out of those trades as the market reverses. Now there could be a developer that would say, well, I'm going to have two states, up or down. I'm going to skip the sideways. I don't think there's a need for a sideways. I would actually argue against that, but my point is not to necessarily explain why I think up, down, and sideways is good, but more to show you conceptually how this works, because someone might have another idea and it might work better for them to do it slightly different. So the question then is, how many states do you define? If we're not simply doing up or down and we introduce sideways, then sideways has to represent a range. So in other words, how do you define a sideways state of the market? It would have to be something like, well, the S&P closes either between -10 or +10. And then anything above 10 points is up, and anything below -10 is down. But as soon as you do that, you can also add other states. Maybe there's strong up, strong down, sideways. What about a short covering state? Some kind of state that would be defined as the market has been going lower, but then it has an explosive rebound off of a bottom like you see on these days as the market reverses. Now, of course, the tricky part is you don't know it happened until it already happened. That's very important as I talk about why this system or why this methodology is helpful in my opinion. Because again, if we knew the market was going higher, we would just go long. If we knew it was going to enter into a short covering rally, we would definitely go long and probably load up because we knew it was going to explode massively. You only know these things happen until after they happen. Even if the Dow is up 100 points for a day, you might say, aha, we're in a short covering rally state. Well, fine, but you don't know. Maybe it's going to reverse the rest of the day, or maybe it will keep going higher. But the point is, you really don't know until it's already happened. If the Dow's up 10 points in the morning, or the S&P's up 5 points, you don't know if it might close up 100 points, or if it might reverse until after it happens. The point is to define these states conceptually, and that each state must be clearly defined. You can't simply say, well, I'll know it when I see it. You have to have a way of defining it, of categorizing the market. And that leads me to the next slide where I'll show you how I do this. Now I'd like to show you the actual states that I use with my state-based design methodology. I use a strong down, sideways, and strong up to categorize the market into these different kind of buckets, you might say. Now, what's very important for me, and this is for me, it might not be the same for everyone if you're trying to recreate something like this. I want to have an equal distribution of the three states that I've defined. In other words, if the market and by the way, I do this on a monthly basis. So what I do is I pull up a chart of the S&P, a daily chart, and I go back 163 months. So that's quite a few months that I'm looking at, and I'm basically trying to see, did the S&P close up 30 points or more? And if so, I count that as a strong up case. Did it close down 4 points or more? Then that's a strong down. And if it's in between -4 and up 30, then that's sideways. Now, you might say, how did you pick -4 and 30? Those are the knobs that allowed these to be equally distributed into thirds. So notice how in the 163 months that are analyzed, 33.74% of the time of those months, the S&P was down 4 points or more. So in other words, a third of the time on a monthly basis on the S&P going back 163 months, a third of the time it closed down 4 points or more. That's strong down for me. And another third of the time, it was up 30 points or more. And then the other third, that middle point, it was between -4 and up 30. Hopefully that makes sense. So I want an equal distribution of these. And I think it'll make sense why as I go on to the next slide. But just think in terms of, let's say instead of up 30, that was up 4. So it was -4 and up 4. What that would mean is my strong up case would have to be up 4 points or more, and this would happen way more often. It might even be 50%. It might even be more. I haven't actually looked at that, but it would be heavily weighted to this strong up case. And again, I'm trying to create these buckets just to show you where I'm going so that I can analyze my trading algorithms to see how they do in each one of these states so that I can figure out where my weaknesses are and how to improve them. So hopefully that helps. This is what I do though. I take a strong down as -4 or more, sideways between -4 and 30, and strong up is 30 points or more. Now what I do is I analyze each algorithm based on the state, okay? Now I'm gonna try to explain what I'm showing here, okay? Consider that there's this long S&P algorithm that I developed. Okay, and by the way, these are examples. None of this is actually real, although this would be similar to my Momentum ES algo, but these numbers aren't the same. But think about this. You have a long S&P algo, so one that basically buys and holds for a couple days or a couple weeks. This algorithm we would expect to do well in strong up cases that happen a third of the time. We would expect it to do okay in these sideways, and then we would hope to either be profitable by some miracle or at least not lose a lot in the strong down cases. But what I do is I'll take the algorithm, I'll take the performance report, and in the code I actually am able to, once a month is done, as it's looping through the back test, a month is done, it'll know what the S&P was. Was it up, sideways, or down? And then based on what that month was, it'll log whatever that algorithm did, and as far as how many points it was either up or down. Now in this case, in this hypothetical example that I'm showing, you might have 1,000 trades, and the distribution might or might not be all of them in the strong, or a third in the strong down, a third in the sideways, a third in the strong up. It might have the majority of its trades in the strong up. But what we know, and I know this gets confusing, what we know is that in the strong up month, that's going to happen a third of the time, generally speaking. In other words, a third of the time a month is done on the S&P, a third of the time it's going to be up 30 points or more, a third of the time it's going to be between -4 and up 30, and then the other third of the time it'll be down. And then this algorithm, once you line up all the trades and put them in the right buckets, there's some average that it'll determine. In other words, if you average all the trades that occurred in a strong up case, it might average 7.24% per month, this algorithm. And then in those sideways cases that occur, maybe it averages down 1.02% per month because it's going long, and so maybe it tends to buy at the top of the range only to get stopped out pretty quickly. And then in the cases where the S&P closes down 4 points or more, which really isn't a lot, but 4 points or more, this algo might average down 2.37% per month. So to summarize what I'm doing here, hopefully that makes sense, but I'm basically taking the back test and exporting the monthly profit or loss, and I'm sorting that based on the S&P's monthly performance so that I can determine the average gain per month for each market state. So really what this is doing is telling me my long S&P algorithm should do really well in months where the S&P closes up 30 points or more. It'll lose a little bit on average in these sideways conditions, and it'll lose a little bit more, but still not a ton in these strong down conditions. And then what I'll do is I'll do the same analysis, but now suppose I had some short S&P algo. Well, we would expect, let me just ask you this. Would you expect a short S&P algorithm to do good on average if the S&P closes up 30 points or more for any given month? The answer is no. On average, you would expect it to probably not do that well because it's going short. Now, there might be times when it does do well, and if it's a day trade, maybe it could be profitable. But generally speaking, we wouldn't necessarily expect it to do well. What about in strong down, though? A short S&P algo, when the S&P closes down 4 points or more, yeah, we would expect that to probably do pretty well. What about if it's sideways, though? That's always the trickier one because sometimes they will do good or they might do better than we expect. But in this case, again, in this hypothetical example, I take this second trading algorithm that I developed, and I've got a video that talks about the design methodology for that. It's under trading algorithm design methodology. But I take the short algo, and now I run it through this same analysis, and I say, how does it do on average in strong down, sideways, and strong up? And now you probably can kind of see where I'm going with this. Because then what I do is I add them together. So I take the long S&P algo and the short S&P algo, and I add them together to figure out if I trade both of these together, what's the performance that I might expect. And that's what this is trying to summarize. The green is the short algo. I probably should have made that the long one, but it doesn't matter. It's the orange, though, is the long algo. So a third of the time, we're going to have a strong up market is what I'm expecting. Now, of course, that might not be exactly a third, but it gives me an idea and some reasonable degree of confidence that when any month is done, 1/3 of the time out of a year, it's going to be strong up. So 4 of those months should be strong up. And when that happens, I have a decent degree of confidence that my long S&P algorithm will average 7.24% in those months. And I've got a decent expectation that my short algorithm on average will lose about 3% on those. So then what do? You just add them together, and on average, in my strong up case, I would expect to do 4.26% per month. And hopefully now you kind of see why I was laboring so much showing you the strong down, sideways, strong up, and why we do that. Because then I do the same for the sideways. The short algo averages 3%, and I'll just round, and the long algo averages -1%. So the net, I would expect in a sideways market condition to be up 2%. And then in the strong down, the long algo loses on average, as we would expect it to. And the short algo has a positive expectation, again, as we would have expected it to have. And so you add those together in 3.74. So what does that do? So what I've done is instead of trying to design one algorithm that does good in every market condition, you're able to focus on one of these market states. You're able to focus on a strong up case, a case where volatility is contracting, the market is going higher, it's going to close up 30 points for that month or more. There might be a lot of ups and downs within that, but this is a numbers game where we're looking sort of on average. So you're able to create a long S&P algo that'll meet that condition, and same with the short. So what that does is this. It means that the real creativity as a designer is not necessarily in making your hero case better. It's more in making sure that you don't lose a lot when it's the villain state. So if it's a long S&P algo, of course it's going to do better in a strong up, or it should, at least on average. But how do you make sure it doesn't lose a lot when the S&P is in a strong down market state, which will happen a third of the time on average? And you might say, well, that's easy. You just make the stop tighter. Go from $800 to $400. And that might clean up the strong down a little bit, but it's going to create new problems in the sideways and even in the long or in the strong up case, because now your stop is $400, and so you're going to get whipped out of more trades in the strong up case. So as you solve a problem in the strong down, it might make a new problem in the sideways and strong up, and that's what makes that's why trading system development is complicated and can be pretty difficult actually. But it at least allows you to kind of focus your effort on the thing that you need to focus it on. And the same can be of the short algo. You might, it's going short, so it's probably going to do really well in strong down. And by the way, if it doesn't, then your stop is probably too tight, or you're getting out too early. There's something else going on probably. But really, designing an algo for the hero state is the easy part. It's the villain state that's difficult. It's trying to minimize the losses, because if you can minimize the losses, that's really the key to having a good system. Because as you can see, when you overlay these algos onto each other, on average, you're going to be up for any given month. But remember, that doesn't mean that every time it happens that way. There could be some weird month that happens, it's super volatile, and the market closes up, strong up, and so it's up 30 points or more. Your long S&P algo, though, maybe it takes a loss of 10%. And that can happen because maybe sometime in the middle there of that event, some really bad news event came out and you got hit hard at the open. So, but these are just averages, and so on average, that's what we would tend to expect. And if you look at this algo, you can identify what its weakness is, right? Which month does the worst amount? The sideways. It's only up 2.21%. And by the way, if this algorithm was real, which again, it's not, these are just numbers that I kind of made up to kind of make my point. If this was a real algo, it'd be an amazing algorithm. I mean, a lot of times you'll have a sideways condition be down a little bit, or maybe even either the strong up or strong down. But having them all be profitable or in the positive is a great sign. But the weakness of this system would be the sideways. So then what you can do is you can say, well, how do I then fix this system and make it better? Well, focus on a sideways algorithm, an algorithm that the sideways condition is the hero state. So what would that represent? Well, you can imagine, maybe you would do trade the range. Maybe you would take breakouts, but instead of holding for a couple days or even all day, you just get out whenever you have a small gain. And so those are the kind of things that you do, and that's the part that requires the most creativity, again, is fixing the villain states. Because quite frankly, if the villain states were all zero losses, in other words, if it was 7.24% in the strong up and the sideways was flat, maybe because it figured out how to not even take any trades, and the strong down was also flat, that would be an amazing algorithm. Basically what it would be saying is a third of the time you should do about 7% that month, and 2/3 of the time just break even. That's fine. If you're taking 3 steps forward and then just sort of marking time the rest of the time, that's great, as opposed to taking a step back. Usually the way these work and what you'd want to expect is that you take a couple steps forward and a couple steps back, 3 steps forward, maybe 1 step back. That's usually how this works. But what this does is it does help you define the problem a little bit more carefully and try to fix whatever issue you might have. So that's all I have on the trading system design portion of this video, where I'm combining algorithms into a single algorithm. Just remember, again, trading futures involves substantial risk of loss. It's not appropriate for everyone. My company and I'm not a CTA, so we can't give you advice. We're a third-party developer, but we do offer the algorithms that I've developed, and you'll see quite a bit of information on the website about them. We offer 4 systems: the Wave Trader, S&P Crusher, Swing Trader, and the Pro Trader. Each one of those went through the design sequence that I showed you, and but I wanted to do this video so that my customers can see a little bit better how I design algorithms. And then if you're a developer yourself, it'll give you some ideas on how you can create things, or how you can improve your design methodology.